This presentation examines how financial derivatives can address investment barriers hindering progress towards United Nations Sustainable Development Goal 7, which aims to ensure affordable, reliable, sustainable, and modern energy for all by 2030. The analysis focuses on renewable energy projects facing significant price volatility and production uncertainty that deter capital investments. By proposing hedging solutions using electricity futures, power purchase agreements, and weather derivatives, this presentation demonstrates that financial innovation can accelerate the global energy transition while enhance economic resilience for clean energy developers and investors worldwide. Renewable energy projects face distinctive financial risks that significantly constrain investments. Wind and solar facility generates variable output dependent on weather conditions, creating revenue uncertainty that complicates project phasing. Research identifies 5 major risks categories: curtailment, policy, price, resources, and technology risks. Electricity price volatility poses challenges because renewable generators sell into wholesale markets when prices fluctuate based on demand patterns and grid conditions. International public financial flows reached only $15 billion in 2022, concentrated among just 25 countries, leaving sustainable financing gaps that impede the tripling of the renewable capacity required by 2030. Electricity futures constructs enable renewable generators to lock in the future selling prices for expected output, converting uncertain revenue streams into predictable cash flows. Traded on exchange like CME Group, this cash-settled constructed cover regional transmission organization service area, allow participants to hedge against day-ahead and real-time market price fluctuations. Research examining the Chinese power market demonstrates that electricity futures substantially reduce revenue volatility for renewable generators, while providing price discovery benefits improving market efficiency. The standardized nature of exchange-traded futures eliminates counterparty default risk through certain clearing mechanisms, addressing significant concern for long-term hedging arrangements in clean energy investments. Long-term power purchase agreements function as over-the-counter forward contracts providing renewable projects with stable revenue foundations. Another important tool is power purchase agreements, or PPA. PPAs are long-term constructed, usually lasting 10 to 20 years. They providing fixed or independent price which help stabilize revenue for renewable projects. In 2023, global corporate PPAs reached 14.6 gigawatts, showing strong market demand. Studies from the US and Europe suggest that well-designed PPAs can reduce risk and support long-term investments. However, price risk is not the only issue. Renewable energy also faces weather-related risk. In recent years, trading volume has increased rapidly due to climate uncertainty, and research shows clean risk reduction benefits. Weather derivatives address volume risk arising from weather-dependent production variable affecting revenues independently of electricity prices. Trading volumes surged 216% in 2023 as climate volatility increased demand for risk management tools linked to temperature, precipitation, and wind conditions. This construct settled based on measured weather indices at specified locations, enable renewable operators to receive compensation when unfavorable conditions, reducing generation. Research using fresh market data demonstrated whether derivatives improve portfolio worst-case value by 42% while reduce earning at risk by 6%. Capital-based pricing methodology enable hedging of correlative weather risk across geographical diversified renewable portfolios. From a theoretical perspective, forward contracts are mainly used to reduce price uncertainty. By locking in price in advance, companies can better predict their future income and manage financial risk more easily. In practice, this idea has been widely accepted by markets. The rapid growth of power purchase agreements across Europe shows that both energy producers and buyers are willing to use their contracts. At the same time, falling risk premiums suggest that investors now see renewable projects as less risky. Low risk usually leads to lower financing costs. As a result, renewable energy projects can offer electricity at more competitive price, which feature supports the expansion of clean energy in the market. Overall, derivatives offer clean and practical benefits for renewable energy projects. By reducing price uncertainty, they improve project bankability and make cash flows more predictable. This gives lenders and investors greater confidence, which helps attract more investment into renewable energy sector. However, despite these advantages, several challenges still remain. One key issue is basis risk. While the hedge does not perfectly match the actual market price. In addition, market liquidity is still limited in some regions, making it hard to enter derivative position. Smaller developers may also face access barriers, such as higher costs or lack of financial support. To address these challenges, stronger and clearer regulation is needed to improve market transparency and stability. Standardized derivative products can also make this instrument easier to use and more widely available. Finally, providing more training and financial education can help smaller developers better understand and apply derivatives, allowing them to manage risk more effectively. Financial derivatives can serve as powerful tools for creating positive change towards Sustainable Development Goal 7. By enabling revenue developers to hedge electricity price volatility through futures and pools, and manage production concerns through weather derivatives, this instrument addresses fundamental investment barriers. Evidence demonstrates effective risk management, reduce financing costs, improves bankability, and accelerates deployment. While limitations exist regarding basis risk, liquidity, and accessibility, substantial growth in corporate pools and whether derivatives trading come from strong market demands. To reach its full potential, this requires ongoing financial innovation, supportive regulation, and better capacity building to support the global energy transition.